In this video, we're going to review common inner circle trader or ICT levels to look out for your next limit order entries. Guys, it is our trades back here with another video. I want to thank you for joining me. If you are interested in trading using a prop firm, consider using Apex Trader Funding. And if you want to support this channel, enter code RTRADES, that's R as in Romeo Trades, all one word, into the coupon section of your next purchase, guys. Or you can use my affiliate link in the description box below. Quick disclaimer before we get into the contents of this video. Trading derivatives or securities involves the substantial risk of loss, including your initial capital or any capital invested thereafter. Do not trade with funds that you cannot afford to lose. Simulated trading may not reflect live market trading, and there are many differences between the two. If you are trading using a prop firm, guys, just be aware these challenges have a very high fail rate. You are more likely going to fail than you are to succeed. Trading has a 90% failure rate or a 95% failure rate. You should be aware of that going in. Okay, guys. With that being said, I want to also put out an ICT disclaimer before I get into these levels. I am not in talking about these levels. I'm not arguing about the veracity or the truthfulness of ICT. You can choose to use his systems or use his methodology or use his terminology or not. There are many traders out there that do use his trading methodology, his trading levels, his trading terminology, and kind of whether or not you think he's a scammer or not, it's really hard to deny that his ideas are out there now. And what I'm going to do in this video is I'm going to show you some of the common levels when you are trying to enter in the market on a limit order that you can pretty readily identify and that you can consider using as your next entry order level. I did make a post on X, guys, talking about this, and these are 10 different levels that we're gonna see examples of on the chart. The first one is called the rejection block, which is the highest or lowest candle body in a swing. The second level is the consequent encroachment of a long wick. Guys, you're going to see a lot of 50% or halfway entries. All right, mean threshold of an order block, consequent encroachment of a fair value gap, consequent encroachment of an inverted fair value gap, consequent encroachment of a volume imbalance, the 25, 50, or 75% of a new week opening gap, 25, 50, or 75% of a regular trading hours gap, 25, 50, or 75% of a new day opening gap, and number 10, the turtle soup entry, guys. There are more out there. We're going to get started with some of the basic ones. All right. So let's say that you are looking to enter in the market. We are looking at the ES while it is trading live, and you are looking to enter in at a rejection block. What is a rejection block? For all of these examples that we use, I'm going to be using the 15-minute chart. Some of the examples, I'm going to be using the regular trading hours. Some of them I'm going to be using the electronic trading hours, which show the overnight session. Just so that you're aware, the overnight session on my trading view is in the lighter shaded blue, while the regular trading hour session is in the darker shade of blue. Okay, it is Monday, April the 14th, and the markets are open. We're slightly higher on the day, 0.4% higher on the ES, and pretty much break even on the NASDAQ. We're down 0.2% on the Russell 2000, and we're up 0.2% on the Dow or the YM futures. Okay, guys, with that being said, what is a rejection block? The rejection block is the highest or lowest candle body in the swing. So looking, for example, at this bright orange line that I've made, look that I've taken our highest swing there. Look at the close was at 54.77 quarters. That is the rejection block. That is the first ICT level that if you were interested in getting short, you could place a limit order right there on the ICT rejection block. Okay, similarly, as the market is now coming back a little bit, we just formed a rejection block located here at the close of our 12 o'clock candle, and that's at 54.06 3/4. So these levels are forming all the time. They're very common. There's nothing particularly special about them. These are just ideas that if you're looking to enter in the market on a limit order, meaning that you want to wait for the market to come to you rather than take liquidity or hit the market, these are some levels that you can use to give you ideas. Let's get some look at prior price action and look where a rejection block may have been a successful point of entry for you. Okay, so we had a rejection block here, a pair of candles between 1530 and 1545 on Thursday. The market came back and visited that level, traveled through it a bit, and then ultimately the market went higher. So if you had a limit order at 52.39 3/4 at the ICT rejection block, that would have been successful for you. An example where the market did not come back to the rejection block, we can see here we had a rejection block at, I'm going to show the price label, 51.70, guys. Again, 51.70, the market did not come back to that rejection block. So that's an example where it didn't quite work out. An example of where a rejection block or putting in a limit order at a rejection block would have worked very nicely. You can see that if we put in a limit order to buy at 52.67 halves, the market came by, and then immediately, very quickly, went back up 75 points. So sometimes, guys, you can hit these rejection blocks really nicely. An example of where if you put your order on the rejection block exactly, the market would have, I think, ticked you. So let's say that you put your limit order on the 15-minute rejection block here, 52.58 halves. The market came down and did not quite get there by one tick. Okay, that's an example of using the ICT rejection block. We can also see here from the 0830 rejection block candle that the market came back up, tested that, and then moved to make a new low, which would have given you a nice trade. Again, the rejection block is the close of the highest or lowest candle in a swing. For example, as the market is trading now, we just formed a rejection block at 54.06 3/4. So you could place a buy order at 54.06 3/4, and that would be taking a trade on an ICT rejection block. Okay, number two, let's talk about the consequent encroachment of a long wick. All right, what is a long wick? Guys, it's exactly what it sounds like. When you're looking at a 15-minute chart, they're all over the place. They're very prolific, but I would typically want to take trades on ones that are at the end of a swing. So for example, we have a long wick here, where I've highlighted the cursor is a pretty prominent long wick on the 15-15 candle from Thursday of April. What we're going to do is take the 50% point using our Fibonacci tool. Most TradingView is not the only platform you can do this on. We're going to take the 50% point of that, and let's say that you wanted to get short. The market came in, did not quite hit that order by a tick. Second time it came in, you can see you made a very nice short there. All right, so if you would have placed a short order on the consequent encroachment of that long wick, that would have worked out well. What constitutes a long wick? It really should just be visually long. It's hard for me to say exactly what a long wick is, but it should be pretty obvious to you that it was a long wick. What's the idea behind a long wick? The idea is that is where the market was inefficiently delivered, or it kind of slipped through. And if you are trading ICT concepts, you know that one of the big, there's basically two concepts that underlie ICT methodology, which is liquidity and inefficiency. So the idea behind a long wick is that the market was inefficiently delivered, and that the market's going to want to come back and redeliver that price in order to make the market efficient. So again, I'm not saying that that's the truth. I'm not saying the market works that way. I'm saying that's ICT methodology. So if you choose to believe in it and you choose to use it, that is what underlies ICT methodology. So for example, as we opened up on Sunday at the 1800 candle, the ES did have a long wick, and the consequent encroachment of that, when the market came up to that consequent encroachment, we had an initial reaction that could have made you about 14 points. Not the world's best trade, but not the world's worst. Okay, guys, so that's the consequent encroachment of a long wick. It's trading off of the 50% point of a long wick. Now, I don't want to make this video overly complex, but this is something I'm planning on making this video basically many, many times throughout my career in different ways, but basically all with the same information. You can invert any of ICT's concepts can be inverted. What does that mean? That means you can use any of these concepts on the other direction or invert it. All right. So, for example, let's say that now that the market is moving higher, and let's say that you wanted to take an ICT short, or you wanted to put a limit order to go short. One example of an inverted long wick would be here from the 10-15 candle. The midway point of that would put you at 54.58 evens, and you could place a short order there. I probably wouldn't do that because we have a fair value gap higher. The point being is that these concepts can invert. So you can use an inverted long wick also to get a trade entry idea. All right. Oftentimes you're going to see that levels kind of come together around the same spot. So for example, we have an inverted long wick here at 52.42.25 as the market came back down. You could have placed a limit order there, and that actually would have gotten you in very nicely. Okay. Same thing here. We have an inverted long wick. So as the market came above and then came back below, you could have placed a limit order at 52.74 halves. The market traded through that a little bit and then moved higher. Okay. So that's the idea, that you can invert any of ICT's concepts and get new trading ideas. Okay, the third, so we've talked about rejection blocks now, and we've talked about the consequent encroachment of long wick. We have also talked about, up until this point, how you can get inverted long wick levels using, again, that magic 50% point. The next level that I want to talk about, or the next pattern, or ICT PD array, which is premium discount array, that I want to talk about, is the order block. Now, ICT will tell you that no one except ICT gets his order blocks correct. I'm pretty sure I have it down, but in any event, just know that ICT doesn't think anybody understands his order blocks. But basically what they are is you are looking for pretty much pullbacks, but where the market has indicated a willingness to change direction, and then you want to take the bodies of those candles. Okay, so it could be, an order block can be one candle, or it can be a series of candles. All right, so what we want to do is we want to identify a swing. All right, these are all based on swings. So for example, as the market is trading down, I want to use a live example whenever possible. You can see that the market has had a clear swing down from when it opened in the regular trading hours to now. The idea behind an order block is that the market pivoted to move higher on the way down, or a pullback, and that is our order block. Okay. What we're going to do is we're going to take 1, 2, 3, 4, which is a series of candles. A series of candles can make very nice order blocks. And we're going to take 50% of the open of the first candle up to the close of the second candle, and that's going to make our 50% of an order block. So for example, we wanted to take this trade, we would put our order right here, 54.67 3/4. That comes also nicely in. You're going to oftentimes see PD arrays kind of around the same price points, but the 50% of the order block is also in the middle of an ICT fair value gap, which is nice. So I think I'm probably going to end up taking that trade if it happens. Let's get some more examples of ICT order blocks. All right, 50% point of this 3 series of candles would have been at 53.61 3/4. The market has not come back and retested that level. All right. An example of an order block that did not quite work out. Okay. 50% point of this green candle at 03.30. If you had taken a short there, the market did move higher, although it did come back into profit at some point. The market did come back at some point and kind of respect it, but there's an example of 50% of an order block. Okay. These series of 2 green candles is an example of 50% of an order block. Again, the market did move higher up into about the consequent encroachment of this long wick, but you could have gotten a short off of that idea. So an example of where the market really reacted well off of an order block is here. So we can see that we had a down move. We had 2 up candles in the opposite direction. That would be an ICT order block. Using the candle bodies is what you want to use, the candle bodies. As the market came back up, if you had a limit order at 53.42 evens, you can see immediately, small bit, the market kind of went slightly higher, but ultimately you would have made somewhere about 100-point opportunity, and the market really just moved straight down. So a very good example of an order block that would have worked out. Okay, guys, same idea behind any of ICT's concepts, which is that they can be inverted. So you can find levels or trading ideas to enter in your limit orders that are inverted. Okay, so here we have an ICT order block, this red candle and the series of green candles in an up move. That's going to be an order block. So what we're going to do is we're going to take the 50% point of that candle body and look at how the market came down and respected that level multiple times. Okay, so there's another example of an ICT order block. And just remember that ICT's concepts can all invert or be used in the opposite direction. Okay, guys, next level. So we've gone through the mean threshold of an order block. Next level is the consequent encroachment of a fair value gap or 50% point of an ICT fair value gap. I'm not going to go through here in this video how you identify an ICT fair value gap. Instead, what I'm going to do is just show you some examples of the 50% point. Plenty of videos out there on how to identify it. Okay, so here we have what's called sell-side imbalance, buy-side inefficiency between the 11 o'clock New York local time candle and the 11:30 New York local time candle. You could take a short at the 50% point of that, enter in a limit order. Another sell-side imbalance, buy-side inefficiency. Again, you could take the 50% point of that and enter in a sell limit order, betting that the market, as it comes back up, is going to reverse. Now, one of the little tips I want to talk about is when the market is trending strongly like this, you are likely going to see a series of PD arrays or a series of fair value gaps kind of entering in a row. If you want to play it conservative and you want to preserve your capital, I would put your limit order higher. So we have plenty of PD arrays to work with here. So for example, we have the first fair value gap, second fair value gap, and then we have the consequent encroachment of a long wick. Then we have a rejection block higher. If I were trading this right now, I would either put my kind of scale into it and put one limit order at 54.69 evens, a second limit order to sell at 54.85 evens, or I would just put my entire order up at 54.84 3/4. You could potentially one sell here, one sell here, one sell here. That's an option. Or you can put it all at the second or the third highest premium discount array or PD array. So 50% point of a fair value gap is another area that you can enter. Okay, number 5, consequent encroachment of an inverted fair value gap or 50% point of an inverted fair value gap. All right. An inverted fair value gap is when the market has traded through a fair value gap and now is coming back down. So let's get an example of that. Okay. All right. I don't particularly use inverted fair value gaps as much as other people do, but one example would be here. This was a buy-side imbalance, sell-side inefficiency. As the market came through the buy-side imbalance, sell-side inefficiency, so again, it would just be a normal fair value gap initially on the way down if you were going to take a long there. Where it inverts is when the market trades through it and then back up to it. So you can see this oftentimes when the market is trending strongly. So let's say that the market has moved straight down that fair value gap there, and now we're sitting in this 4 o'clock candle. You could use that same consequent encroachment of that PD array, or 53.21 3/4. All right. And as the market traded through it, you can place your limit order, and that actually would have worked out very nicely. Another thing I want to mention to you is that PD arrays oftentimes stack. You'll kind of notice that PD arrays or ICT patterns tend to stack around the same price point. So you could have also used this inverted order block. Okay, the 50% point, that wouldn't be inverted. Just that order block there as the market came back up, or you could use the consequent encroachment of this inverted fair value gap. They would have gotten you pretty close to 53.22, which is where the market turned back down. Okay. All right. So that's using the consequent encroachment of an inverted fair value gap. All right, consequent encroachment of a volume imbalance. A volume imbalance is when you have a 3-candle pattern and there is a gap between the 2 candles. I don't think I have any examples of that here on the ES. Basically, you can look at that and enter in at 50% of the volume imbalance. I don't really have any examples of that here at the moment. Okay. 25, 50, or 75%, any of those 3 levels into a new week opening gap. All right, and luckily we did have one here on the ES this week. So the new week opening gap is the difference between where the market closed on Friday and where the futures open on Sunday. That is the new week opening gap. If you take that into quarters, you can set limit orders to buy at anywhere from the 25% to the 50%. You can see that played out nicely here on the ES. You had a Sunday trade that immediately, let's say you placed a limit order right at that 50% point. You immediately could have made up to 26 points or 21 points just by placing a contract at the 50% point of the new week opening gap. Okay. So again, I probably wouldn't keep using that over and over and over again, but you can. So the 25, 50, and 75% of a new week opening gap, there's a lot of play on those levels. You'll see a lot of market activity around those 3 levels as well. You can see that the market even came back and gave you another opportunity here, got very close. If you had placed a buy order at the 25%, obviously that could have worked out very nicely for you as well. Okay, so you can use the new week opening gap if there is one, especially on Sunday. I don't want to call this a Sunday hack, but it's something you can use on Sunday futures when they open. And you could have had a couple trades off the new week opening gap. Okay, so now we've been through the new week opening gap. All right, 25, 50, or 75% of a regular trading hours gap. I think that there are potentially some examples of that today. All right, so we have a regular trading hours gap between Friday and Monday's trading. You could have taken a long, as we're speaking today, at the 75%. Yes, the market came down and traded lower, but as of right now, you'd be in some profit. You'd be in 18 points of profit, which is not a bad scalp. All right, so basically all you're doing is you're taking the difference between Friday and Monday's trading, or any day. You need to move your trading view to regular trading hours. I believe that there are other platforms that allow you to move only to see regular trading hours as well. And you can enter in limit orders using the 25, 50, or 75% of the regular trading hours gap. Okay. One other thing I want to mention is that, like anything, ICT levels can invert. So if you are using a regular trading hours gap as a level, for example, let's say that 75% of the regular trading hours gap between Monday and Tuesday on April 8th, you can see that the market came up and kissed the 25% point or 75% point at 51.64. So you could have used that as an idea to get short on an inverted regular trading hours gap entry. That's pretty advanced. I wouldn't expect everybody to be doing that. But again, you can use any ICT concept and you can invert it and use the levels. They're just giving you ideas to enter, and anytime, for example, on Tuesday that you would have entered short, you would have been on the side of the prevailing trend and you would have made money. These are just giving you ideas of where to enter if you're going to enter in on a limit order. Okay, let's go back to the electronic trading hours. All right, the 25, 50, or 75% of a new day opening gap. Okay, guys, sometimes there is going to be a difference between when the market closes at 4 o'clock and then that hour of when the market opens back up on 5 or 5 to 6 Eastern Standard Time. Let me see. I'm not sure if I have any examples of that on the ES, but it's the same idea as when you're using a regular trading hours gap or a new week opening gap. If you have a new day opening gap, you can break that out into quarters and use those as levels. Okay, guys, finally, we have the turtle soup entry. This is not something that I particularly like doing, but basically what you're going to do on a turtle soup entry is you're going to take your swing high or your swing low, and then place a counter order or a level to, you're just going to sell a new high or you're going to buy a new low. I'm not a turtle soup guy. When the market is in a trading range, however, this is something that can potentially work out. All right, so for example, let's say that we had this low Friday, 11th of April at 0430. The market came down, ticked below. If you had put a buy order in liquidity one tick below the low that was formed at 0430, that would be a turtle soup entry, and it would have obviously made you a lot of money. You can make a lot of money doing this. However, it's in my opinion, it's a little bit risky because you are trading against the trend. But it does sometimes work. So, for example, here we had a turtle soup entry at 53.51 3/4. If you place an order one or two ticks above that, you would have gotten in a turtle soup entry. But notice also that we had a long wick, consequent encroachment of a long wick at 53.65. Okay. So notice that we had a long wick at 53.63 3/4. That would have gotten you closer to where the market actually made a high. We also had another long wick. Let's see where that was at 53.70 3/4. That would have gotten you even closer to where the actual high was. So the turtle soup is not really what I would have gone for, but I want to make you aware that you can enter in at a new high or a new low, and that's called a turtle soup. All right, that's another ICT PD array. Okay, guys, anything else that I want to mention at the moment? There are other ICT PD arrays that are out there. There are many. There are breaker blocks, reapers, and I think he just came out with something called the Venom model. I'm not going to go into that in this video. Basically, I use order blocks, I use long wicks, I use rejection blocks. I really like using long wicks, rejection blocks. I will sometimes use fair value gaps and inverted fair value gaps. I don't really use breaker blocks that much. I'll be honest with you. Breaker blocks are not really something that I use very much, but you can absolutely use breaker blocks as well. Okay, guys. With that in mind, there's something I wanted also to mention, which is an order block above a fair value gap. Okay. When you have, it's a very, very strong, in my opinion, it's a very strong entry level. But when you have an order block that is sitting above a fair value gap, you're probably going to get an excellent entry. So there was an example of that this morning that I took, and I'm not exactly certain whether you would call just this one candle an order block or not. You could have just also traded off the fair value gap, would have been fine. All right, so on our opening candle, the first 15-minute candle of regular trading today, you can see that we formed what's called a sell-side imbalance, buy-side inefficiency. Sitting right above that is what I would argue would be an order block, or the 50% point of just this candle body. I took a short on the 10 o'clock candle, and I took another short on the 10:45 candle. You can see that that absolutely was an amazing entry. So whenever you see an order block that's sitting below a fair value gap or an order block that's sitting above a fair value gap, I think those are excellent entries that you should be looking out for, in my opinion. One other item that I wanted to mention, guys, is statistics show, and this is not ICT, but statistics show that about 70% of the time, whatever the first 30-minute candle is on the ES or on the NQ or any of these stock indices, 70+% of the time, the market is going to close in the same direction as the 30-minute candle. So what do I mean by that? The first 30 minutes of trading are pivotal for the day. 7 out of 10 times, sometimes I think the statistic is up to 73%. The market is going to close in the same direction as the first 30-minute candle. This is something that I wanted to talk about that I'm probably going to make a short video on. But notice for today, for example, our first 30-minute candle was down. The market's been trading down. The first 30-minute candle on Friday, the market was a green candle. The market finished up. The first 30-minute candle or the on Thursday was red. The market finished down. The first 30-minute candle on Wednesday was a green candle. The market finished way higher. The first 30-minute candle on Tuesday was a green. The market finished lower. So that was a counter example. On Monday, the first candle was a green candle. The market finished higher. Okay. On Friday, the first 30-minute candle was a red candle. The market finished lower. On the prior Thursday, first red candle, first 30-minute candle was red. The market finished lower. So about 7 out of 10 times, 7 to 73%, but we'll call it 7 out of 10 times, whatever the direction of the first 30-minute regular trading hours candle is going to be the way that the market ends up for the day. So just going through the data that I just showed you for about a week, there was only one example where that was not the case. So be aware that for the most part, when you're trading these ICT premium discount arrays, you're looking for limit orders. You want it to be 7 out of 10 times in the same direction as the 30-minute opening candle. Okay, guys, this has been Our Trades back here with another video covering ICT entry levels. There are others out there. There are breaker blocks. For example, there's the Reaper model, the new Venom model, the ICT model 2022. There's plenty of other ICT concepts to learn, but these are some of the basic entry PD arrays that I think every ICT trader should know. Okay, guys, thank you. Please make sure to use my affiliate link on Apex Trader Funding. That's code RTRADES, all one word. If you are on X, please make sure to follow and leave a comment on this video, especially if you made it all the way to the end. If you're on YouTube, please make sure to leave a like and subscribe and comment. I really enjoy that engagement. See you on the next one.